Hopefully at this point everyone has a general understanding of the model structure. With a well-written business plan, John is ready to search for his investors. But wait, are these the assumptions John wants to bring to market? Let's put his predictions to the test. Notice in the right-hand corner we have displayed the overall IRR for both the limited partner and general partner. This will allow us to quickly assess the sensitivity of John's assumptions. I'll make a copy below to use as our base case scenario. Looking at John's market assumptions, some will view his real estate predictions to be on the pessimistic side. But John trusts his data that shows that the U.S. economy cannot be stimulated until the green technology kicks into full gear, in about 2 years. So until the evidence proves otherwise, he wants to keep his market assumptions as is. As for the operating assumptions, these expense ratios are based on real estate portfolios John has managed in the past. Again, debt assumptions are based on availability of the line of credit proposed to the bank. For purposes of this demo, we will keep these two sections consistent as well. Let's dive into the acquisition assumptions and see if we can improve the investor returns by modifying the parameters. John plans to make his first acquisition in February of 2009, and then one purchase every 6 months for the next 3 years. But if John's so confident in his market predictions, why not wait until the bottom? According to the market index, real estate will bottom at the end of 2010. So let's make the first purchase during September of that year. There's a problem. The model is reporting a negative cash balance. If John starts buying that late in the cycle and continues his strategy of purchasing every 6 months, acquisitions will run well into the market upswing. The current structure of the fund will not have the necessary capital to buy at those price points. Therefore, we need to tighten up the timing of acquisitions. How about 3 months? Wow, both investor classes perform significantly better. But let's be more realistic. Trying to time the market like this is nearly impossible. Spreading out the acquisitions over the next 3 years will allow the fund to accumulate their properties at a more conservative average price. Before we test the capital assumptions, let's review the current waterfall of distributions for this real estate fund. By looking at the liquidation event, we can visualize the priorities of distributions. First, the fund will return the capital invested. Note, the LP and GP received tax distributions in a prior quarter, hence the amounts you see here are less than what they contributed. Next is the limited partner's preferred return, followed by the general partner's basic return. Finally, after the capital and returns have been paid, the fund will split remaining cash to the LP and GP at 80 and 20% respectively. Remember, one of the primary strategies is to ride the market upswing until it levels off at the end of 2014. So how is the IRR going to be affected if the fund liquidates earlier or later than that inflection point in the market? If we change the date to December of 2013, we see the limited partner's IRR increase as their capital is returned quicker, but the general partner, aka John, will realize a drop in his return. At this point in the investment's life cycle, he will benefit more from the extra year of real estate appreciation, since those funds will fall into the 80-20 distribution priority. If we change the date to June of 2015, we can see the IRR for both investors is lower than our base case, and that's not what we're looking for. John now has perspective of how the timing of the fund's liquidation correlates to his return. If an investor needs his or her capital back in a shorter time span, John knows his IRR will decrease. But, depending on the availability of capital, he may need to take that hit. Good news! John's hard work paid off. He reached out and connected with 3 major investors. Each one wants to invest $2 million. This is great. Now John has a $6 million real estate fund. If the fund has more cash, it should be able to buy more properties. Let's bump the number of units per purchase up to 10. Nope, not enough cash for that size portfolio. How about 9? Perfect, no negative cash balances. And look, the limited partner's IRR remained within 10 basis points. John's, on the other hand, increased to 120 basis points. As you can see, there are thousands of what-if scenarios we can easily run through with this model. I hope this demonstration conveyed HiE's ability to convert our clients' ambitions into dynamic business models anyone can use. If you have any questions about this model or would like to discuss your own ideas, please send us an email or give us a call. Thank you for your time and consideration.